Well, hi there, Sean Humphreys here. Welcome to All Things Retirement. Well, in this installment, we're going to talk about a very important retirement income planning strategy. We refer to the strategy as timeline investing. It's a strategy that helps to reduce portfolio risk, particularly as you transition into retirement, and the strategy also helps to improve the probability that you will reach your long-term performance goals for your retirement portfolio. So you'll find this strategy outline very helpful. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on the transition phase into retirement, the being retired phase, but also the accumulation phase of retirement as well. Now, when it comes to retirement income planning, one of the biggest risks that retirees need to contemplate, wrestle with, and then put strategies in place to deal with is the drawdown of capital, what we refer to as de-accumulation of capital, in the midst of an environment where maybe markets are going down. So that's double jeopardy for retirees. So how do we plan around that? How do we get income into the hands of retirees while at the same time navigating uncertain economic environments and capital markets? Well, the strategy, at least one of them, is a strategy of timeline investing. So let's just take a look at a schematic that really summarizes it for you. So when you look at this timeline, essentially we've got year 1 on the left here, year 10 on the far right. So we've divided this timeline into 3 components. Now the first component of this timeline investing could be what we call cash equivalents, an income wedge, or a cash wedge. Now this is money that is earmarked to supplement other sources of pension, maybe your primary income source, maybe to provide liquidity needs for lump sum expenses, maybe upgrading the vehicle, maybe renovations on a home, maybe it's additional travel and lifestyle goals that you have. Now this money is likely going to be needed over the first 3 years of retirement. And it's money that you can't take any financial risk on. You've got to be very conservative with it so that when you need to go into the portfolio to take the money out to supplement your cash flow, you're never worrying about selling that off at a loss because markets are down at that time. So you may not be getting a great return, but it really is a safe harbor, a place that's got money in reserve to provide the income requirements so you never have to sell something at a loss to produce the income. Now, when we put together retirement income plans, what we're trying to do is identify through the planning and budgeting how much money do we have in this component. We don't want to have more than enough because it's going to be a drag on portfolio performance. But we need sufficient dollars in this part of the portfolio. Now once we've got the first 3 years of cash or liquidity needs looked after, the next component would be a timeline of roughly 4 years to 6 years. And so now we're dealing with a little more time and we can afford to see a little more fluctuation in the short term in the hopes that we'll get better long-term performance on the portfolio. Now these investments need to be more of a balanced mix. It's important that we have some fixed income and diversification in the portfolio so the swing rate on the portfolio is not extreme. So we're definitely trying to beat what the client could get in a GIC or a term deposit, a bond, more conservative holdings. So we're trying to boost up the performance, but we're still trying to be conscious of short-term market volatility and short-term risk because we have to go into this part of the portfolio potentially in the next 4 years or so. So we've got some time to take on a little bit of short-term risk to boost the performance, but we can't have excessive risk. Now the third component of the portfolio, timeline usually 7-8 years and more, now we're talking about long-term growth strategies. At the risk of sounding too simplistic on this strategy, at the end of the day, these growth strategies, the most important thing here is high quality, some level of diversification, and emphasizing growth investments in the portfolio. That's where we're going to get most of our performance on the portfolio. Time and quality and diversification on the growth or stock component of the portfolio will be the investor's best friend. Now, like I said, the retirement income plan will help you to define how much capital needs to be in component 1, the first component of the timeline investment portfolio, component 2, and component 3. And what we're trying to do is find that sweet spot between income and liquidity needs, your risk profile, and overall return objectives. And those will all influence the design of the various investments will be in the different parts of the portfolio. Now, when it comes to this growth component, because of time and diversification and quality, you can often use lower cost investment solutions for that component. It could be just high quality blue chip stocks, paying quality dividends. It could be index contracts or exchange traded funds or ETFs. All you want is exposure to the broad market or high quality securities and just ride those securities over time, and periodically taking profits, harvesting and protecting those profits. That's critical for retirees to do. Now the middle component, you're dealing with security solutions that are worried more about the short-term risks. A 4, 5, 6 year time period is still relatively short-term in the grand sweep of your investment time horizon. And so the securities that we would use would worry about things like currency swings between the Canadian dollar, the US dollar, and other world currencies when it comes to investing. It'll look at fiscal or government policy. It could impact the investment and economic environment, monetary or central bank policy, and then look at the overall valuations in the markets or differences between different sectors of the economy and try to exploit those opportunities or differences. So there are different investment strategies you would use for each of these components. And one of the things that we do is we develop the retirement income plan, the timeline investment solutions, and then come up with recommendations on how to invest in each of those sectors. Anyway, I hope that you found this discussion helpful, and if you're looking for more resources, we've got some links to different resources. You can get to our website to find out how to get a financial plan or retirement plan. You can also reach out to us if you have questions, and it's my hope that you found this discussion helpful. Anyway, wishing you all the best in your retirement planning, and if you haven't subscribed, make sure you do that so you don't miss future content that we're posting on a regular basis. You take care.